Meanwhile, S&P has also said that it's cutting its growth forecast now going forward. It's the next one in line after a slew of forecasts that have come in that have been wiping out the year's gains and talking about lower growth. Let's in fact take that to Taimur Baig, who's joining us this morning, Chief Economist and Managing Director at DBS. Taimur, good morning from us here in Mumbai. Just to get your sense really on the implications, the larger implications on growth, given what we're now hearing from S&P after we've already heard it as well from some of the other key brokerages and banks previously in the last couple of weeks. How big a scare is this?
Look, this is largely a supply-side shock, but if we don't manage to stop panicking, it will certainly become a demand-side shock by hurting jobs, earnings, and sentiment. That's the risk, I think, that the Fed was worried about last night, because data available out of the U.S. really don't suggest that short of some concerns about stocks of products going forward, there's anything major going on. But clearly at the G7 level, there is considerable concern that it's not just a question of supply chain disruption out of China, something that can be made up in a month or two of working double shifts. But it is something beyond that, which is that there's a global dimension, there's a lot of panic, and as a result, travel, transportation, tourism are getting affected. And once we not only see intermediate parts from China not going elsewhere, but also see intermediate parts from elsewhere, for example, Germany or Italy, not going to China, then we have a double disruption, if you will, of the global supply chain. So as the pandemic has taken on global dimensions, I think the policymakers outside of China are getting quite concerned. But as you can see from the market's response, they don't really expect monetary policy to solve a virus crisis. I think if we see more coordinated response, more fiscal response, perhaps it could act as a better band-aid than just lowering interest rates. And that's where I suppose the disappointment lay yesterday or this morning, that it was just the Fed cutting and nobody else did a whole lot more.
We'll hold on to that thought. We've also got Hugh Johnson joining in on the phone line. Hugh, hi, good morning. Just to take away from the point that Taimur was making, do you now see a synchronized central bank action? I mean, we were just talking about and anticipating as to what the Indian central bank, for instance, would do. Is it a given that we are going to see a series of rate cuts across central banks across the globe?
Well, I would hope so. But, of course, the fact that G7 didn't do anything and the U.S. did cut rates, the federal funds rate by 50 basis points, doesn't tell me for sure that it's going to be a synchronized or a coordinated global cut in interest rates or their primary rate. So I'm not confident that's going to happen. It should happen, but it's just not at all confident. We haven't reached that point in global economics yet, as far as I can see, where there's coordination among central banks. You see central banks really acting independently, and I don't see anything that tells me that that's going to be anything different. I think we'll eventually get those cuts in response to weak global economic activity, but coordinated, synchronized, I don't think those words apply quite yet.
Taimur, many worry that, what happens to economies like India, which was already grappling with the growth slowdown, and now do we see the RBI, which has been in pause mode for the last two policies, maybe an outside chance ahead of the April review as well, maybe a steep cut in rates?
Perhaps, but I think we need to be realistic about the impotency of monetary policy in a supply-side shock that one is dealing with. It is absolutely useless as far as, putting the supply chain back in order. Now, you could argue that if there is a credit crunch, if there is a liquidity tightness, we see spreads widening substantially, then perhaps more liquidity provision from the central bank can help address those risks. But given the amount of excess reserves that banks worldwide have and the kind of forbearance that the authorities can put through, I really don't think that's an issue. So the question is, can the government do something in terms of easing the tax burden of businesses? Can they do something on the regulatory side to make settlement of trades and so on a little more seamless? That is action one needs to take. I really don't think monetary policy easing is going to impress any market participants or have a major impact on the global economic momentum. What needs to happen is not necessarily globally coordinated monetary policy action, but internally coordinated fiscal monetary action. That's where I think the biggest disappointment lay. I think the market basically says U.S. Congress is utterly incapable of taking any major fiscal action unless things get much, much worse.
But Taimur, do you really think India has the elbow room for the government to actually put in place fiscal as well as policy measures? Because, we've all seen as to how they've grappled with the deficit, the announcement just made in the budget, previous month. And more importantly, we've known as to how they've been grappling with the disinvestment proceeds.
Indeed, no, it's a very difficult set of circumstances given the very limited fiscal room that the government of India has. But speaking as far as emerging markets in general, I just saw this morning the World Bank announcing a financing facility in terms of dealing with coronavirus response. I think that's the sort of multilateral response that we need, which the emerging markets can reach out to make sure that even if they have limited fiscal room, resource constraint is not going to be the problem as far as dealing with this public health issue. So far the outbreak has been relatively limited in nature. Even in countries like Korea, when we talk about thousands of cases of coronavirus, we're not talking about thousands of people dying or critically injured. That's really only the case of China, which actually has, by all indications, turned a corner. For the rest of the world, it could easily get much, much worse if large emerging market economies see an outbreak, and then we can see the virus spreading not to a few thousand, but hundreds of thousands of people. At that point, no amount of monetary policy easing is going to help. There will be so much panic and so much concern. What would be needed at that point is fiscal response. And if fiscal space is limited, one would have to reach out to multilateral agencies and get the money in place as quickly as possible. So we're not in it alone. India does not stand alone. India is part of G20. I'm sure whether it's the finance minister or the central bank governor, everybody's in conference calls with the G20 and thinking through this issue and finding out what are the lines of credit and the cash that is available with the Asian Development Bank, with the World Bank, with the IMF that can be drawn upon at a time like this. So we should not only think of the policy response in the context of what the government of India can do, because which in all arguments is not much, but we're not alone. There's a world out there which I'm sure would be extending a helping hand.
Absolutely. And taking from that, Hugh, I want to pose that question to you as well in terms of the impact of monetary stimulus here. While everyone's been crying out for it, the reaction on the stock market yesterday on the Dow just showing perhaps that, there are limits to what we can hope to achieve through monetary policy at this point. And, given already where we're seeing stock markets trading, if you take into account the bounce back yesterday and given the recent highs, is there going to be a growing disconnect given what we're expecting on growth?
Well, clearly, the monetary policy, I think everybody knows that monetary policy isn't going to be able to do a whole lot under current circumstances. I think what was problematic for the stock market yesterday is that, first of all, the Federal Reserve unexpectedly cut interest rates between meetings. That has been for a long time uncharacteristic of the way the Federal Reserve operates, and they, of course, cut by more than they ordinarily cut, and that, of course, being 50 basis points. That surprise seemed to indicate to investors that perhaps the problem is, at least in the minds of people at the Federal Reserve, bigger than we had previously thought. And I think that is what basically the investors generally responded to. And I think investors are generally on the right track, and that they're basically pricing in the fact that U.S. economic growth in 2020 and 2021 is not going to be as strong as we've been widely forecasting, 1.8, 1.9, 2%. It's going to be lower than that. It's going to be maybe something like, I have it at 0.6% and very close to a recession in 2020. So the markets are really pricing in that kind of an outcome for the U.S. economy. I would say a soft landing, not a hard landing or a recession, but it's a really close call, and that's what the markets are telling you. The good news, or the silver lining here, as I do the numbers, is that I think that the markets have priced in a little bit more than we're going to get. In other words, I think the markets have gone from being overvalued and even somewhat speculative before this broke out and are now somewhat undervalued, about 4% undervalued, with a little bit of upside potential. So that's kind of the silver lining. I think we've really gotten to a level that makes a little more sense. Not that we can't go down further, but we certainly have gotten to a fairly good level, at least in the U.S. stock market, or it's overly discounted the soft landing that I think lies ahead.
You as well as Taimur, both of you, thank you so much for taking the time out and speaking with us this morning. Good to get in your views as always.